Is crypto still worth investing in 2026? This is the question on the minds of millions. From seasoned investors to curious newcomers, welcome to Neuro AI. Here we look at the facts, we measure the risks, we explain complex topics in plain words. A space for calm, data-driven analysis. The world of digital assets has matured since the retail frenzy of the early 2020s. It still feels like a frontier, towering innovation, and deep volatility. Understanding this terrain is essential before you commit your hard-earned capital. I will share clear, verifiable data to build a comprehensive picture. We will look at market leaders, Bitcoin, Ethereum, the growing role of stablecoins, other promising tokens. We will explain technologies, shifting regulations, and the very real risks that persist. By early 2026, the crypto market has endured multiple boom and bust cycles, emerging more resilient but more complex. Total market capitalization is a key metric and has fluctuated significantly since its previous peaks. As of late 2025 per coin market cap and CoinGecko, it often hovers in the low single-digit trillions, a substantial figure, yet more sober than the most euphoric phases. This is a composite of thousands of assets still dominated by Bitcoin and, to a lesser extent, Ethereum. 2020 to 2022 saw unprecedented growth, institutional adoption, DeFi summer, and the NFT craze, followed by a prolonged crypto winter. By 2026, survivors have stronger fundamentals, clear use cases, and dedicated teams. A flight to quality, investors more discerning, less susceptible to pure hype. Crypto is no monolith. It is a set of distinct subsectors. 3 data points. Bitcoin dominance stabilized around 40 to 50%. DeFi TVL over $100 billion. Stablecoin supply above $200 billion. Narrative has shifted to utility and infrastructure, transaction throughput, regulatory compliance and real-world asset tokenization. Institutional players deepened infrastructure, custody, trading desks, derivatives, laying a more professional foundation. The market is adolescent, past infancy, not yet mature. To understand value in 2026, look past price charts to the underlying technologies. Blockchain is a distributed, immutable digital ledger, a chain of blocks, each holding a batch of transactions, linked by cryptographic hashes, maintained by a network of computers, not a single bank, providing censorship resistance and trust minimization. Built atop blockchains are smart contracts, self-executing agreements. On Ethereum, they automate processes without intermediaries. Example: escrow that releases funds when conditions are met, or governance for decentralized organizations. Early chains faced scalability issues, slow transactions and high fees. Layer 2 solutions, Optimistic and ZK rollups. Bundle transactions off-chain and post-compressed proofs on-chain. By 2026, rollups are integral, faster and far cheaper. Non-fungible tokens are unique digital assets with on-chain identity and ownership, expanding beyond art into identity. Ticketing, in-game items, and real-world ownership. NFTs open a new paradigm for digital ownership and monetization online. With the tech framed, let us examine Bitcoin, Ethereum, and stablecoins. Bitcoin remains the undisputed king, the asset that started it all. By 2026, its narrative is digital gold, scarce, decentralized, secure, hard-capped at 21 million, resilient for over 15 years, often seen as a hedge and long-term holding. Drawback: limited functionality beyond value transfer. Ethereum enables smart contracts and decentralized applications, the foundation for Web 3. The merge shifted Ethereum to proof of stake, slashing energy use and making ETH yield-bearing for stakers. Scalability remains the challenge, improved by Layer 2 solutions. Stablecoins bridge traditional finance and crypto, designed to hold a stable value, commonly pegged to the US dollar and backed by reserves. They provide low-volatility rails for trading and payments. Main risks are regulation and reserve transparency. In 2026, Bitcoin, reserve store of value. Ethereum, in programmable infrastructure. Stablecoins, transactional medium and unit of account. For investors, BTC is a bet on money, ETH on a computing paradigm. Stablecoins are utility, not appreciation. Beyond Bitcoin and Ethereum, altcoins form a vibrant but risky landscape focused on specific niches. Alternative Layer 1s compete on speed and fees. Even with rollups, platforms offer different trade-offs across decentralization, security, and developer ecosystems. Altcoins increasingly map to sectors: DeFi, oracles, gaming, and infrastructure. Oracles bring external data for smart contracts. DeFi tokens like exchanges and lenders use governance tokens granting voting power and economic rights akin to decentralized cooperatives. Gaming and metaverse tokens power digital economies, buying land, building experiences, trading NFTs, highly speculative. Success hinges on active users and compelling content. Evaluate altcoins with stricter filters. Does it solve a real problem? Who is the team and track record? Is there a genuine community? What are tokenomics and incentives? A small basket of promising altcoins can add upside. But treat this as the highest risk slice of a crypto portfolio. Investing in 2026 still offers asymmetric returns. Overnight millionaires are rarer, but successful projects can outperform traditional assets. A protocol capturing a sliver of a legacy market can rise by orders of magnitude. A small allocation can diversify portfolios. Rapid innovation, proof-of-stake, roll-ups, addresses energy and scalability, strengthens the ecosystem, and opens the door to mainstream use. Cons are formidable. Extreme volatility, swings of 20% in a day are not uncommon. Short-term trading is risky and taxing. Projects can crater from downturns, hacks, or narrative shifts. Invest only what you can afford to lose. Operational risks persist. Self-custody boosts security, but carries responsibility. Lose your keys, lose your assets. Scams and phishing remain common. A balanced view, weigh potential against risk before you buy. Diligence, skepticism, and technical literacy are essential. By 2026, regulation moved from ambiguity to implementation, new challenges and opportunities. Key regions require licensed exchanges, enforce KYC, AML, and clarify tax reporting. The EU MiCA framework set comprehensive rules. Clarity improves consumer protection and enables institutions, but heavy-handed rules can stifle innovation. Token securities rulings can render assets untradeable. Stablecoin and DeFi rules are evolving. Stay informed in your jurisdiction. Custody is paramount. Exchanges improved, but catastrophic hacks can still happen. Hardware wallets store private keys offline, the gold standard for self-custody. Even then, vigilance is vital. Phishing and social engineering target recovery phrases. Scams persist, rug pulls and pump and dump schemes. Defend yourself with skepticism, team verification, audited code, and rejecting guaranteed returns. If an offer seems too good to be true, it almost certainly is. There is no one-size-fits-all strategy. Your situation, risk tolerance, and time horizon dictate the approach. Conservative profile, limit crypto to 1 to 3% focused on established liquid assets, Bitcoin and Ethereum. Dollar cost averaging reduces timing risk and tempers emotion. Growth profile, 5 to 10% allocation, 60 to 70% of that in BTC ETH, plus a carefully selected basket of altcoins. Focus on platforms, essential DeFi, and infrastructure with real adoption and strong teams. Expect deep drawdowns. Active trading is riskiest and not for beginners. It demands time, expertise, and strict risk management. Most traders lose money. Hodlers accumulate core positions, secure in cold storage, ignore short-term noise, and hold for 5 to 10 years or more with patience and fortitude. Success for long-term investors is tied to broad adoption of the asset class. Choose the path that matches your goals and temperament. So, we return to our initial question. Is crypto still worth investing in 2026? The answer is not a simple yes or no. The landscape is a complex tapestry of innovation, opportunity, and risk. Decentralized ledgers, smart contracts, and verifiable digital ownership are enabling tangible value in finance and gaming. For believers in the paradigm shift, a long-term investment case remains compelling despite volatility. Yet challenges are formidable: extreme volatility, regulatory pivots, and security threats. From sophisticated exploits to simple phishing, success demands diligence, not blind optimism. The path forward is cautious, well-researched, and deliberate. Let your goals and risk tolerance guide you. This information is a foundation for your own research, not financial advice. Know your goals, understand the risks, use unbiased data, follow security best practices, investigate teams, verify code and audits. Protect private keys as if they were your life savings. Stay compliant with local regulations. The crypto market of 2026 is for the informed, the patient, and the prudent. Thank you for joining us on this detailed exploration. This was Neuro AI. In a world of hype, clarity is your most powerful tool. Keep learning.